Hi, everyone. I'm Rick Bensignor. Today's Tuesday, June 8th, and welcome to this week's In the Know Trader Show. On tap this week, we're going back to trader education, and we're going to talk about how you're all wired to make investment mistakes. We all are. And we'll talk about what some of them are and what we can do about them. In our market overview, we'll take a look at the Qs. That's the NASDAQ 100 tracking ETF, the TNX, which is the US 10-year yield chart, and then growth versus value. That's IBW divided by IBE. And in our sector analysis, REITs are finally on the move and collectively as a group breaking out to the upside. So we'll take a look at as many of these as we can get to. These are the top 10 holdings in the XLRE, the SPDR REIT ETF. As a reminder, we put out two publications. One's a weekly, that's the weekly ETF Tactical Trader Report. It comes out Thursday nights. Gives a new ETF trading idea each week, goes over the S&P, what's going on there, the US 10-year, and usually the dollar and or gold. As well as walking you through every open trade we have until those trades get closed out. Again, that comes out Thursday nights, available for subscription through theknowtrader.com. And also, we come out with a monthly 7-Eleven report that the goal of that is to beat the S&P's return by being in no less than 5 or no more than 7 of the 11 macro SPDR ETFs. And after 10 months since we started last August 1st, we are outperforming the S&P by 3.41%. That comes out the last trading day of the month after the close. And again, you can sign up for that at intheknowtrader.com. My email address to reach me for questions, comments, etc. is rick@intheknowtrader.com. Okay, let's move to our trader education portion. And I came across a new study a day or two ago. It was just released, and it showed that 98% of all investors exhibit one or more financial biases. You know, the study went on to show that the more of these you have, and there are dozens that you could have, the more of them you have, the higher the likelihood that you have poor financial outcomes in life, like poor credit scores, lower balances in your savings accounts, and lower balances and overall success in your investment accounts. So, as you know, I have been a subject matter expert in behavioral economics and behavioral finance theory for many years. I was the first to teach it at those courses at NYU in New York. And many occasions we've talked about these type things in the past, but given that there's a new study out, it's just as good a time as any to take a look at some of the findings in the study and then talk about them and what we can do about them. So let's start off with the first one that this study finds particularly present in investors. And again, you're wired for this. There's very little you can do about not having these. The most important thing to know is that you have them and how to get past them. So we'll talk about that. So the first one is what they call present bias. It's also known as current bias. And it's basically putting a lot of factor and weight into immediate rewards that you can use your money for versus long-term goals. Now, that assumes you have long-term financial goals. And that's probably the most important thing to start off with, is to make sure that you have long-term financial goals. If you can read, there's lots of books on this stuff on, how to set those up. Depending upon your age, if you're in your 20s, your long-term goals are different than if you're in your 40s or 50s. And yes, in your 50s, you can still have long-term goals because you could easily live well into your 90s these days. In fact, just recently, I heard that if you have a child now, that child is estimated to live to about 103 years old. And that's also recent findings. So in order to plan for your future, you got to have long-term financial goals. And again, you can find lots of resources to help set those up and track them and abide by them. And if you need more help and you find like you can't do them on your own, you could always go to a financial advisor. It'll cost you money, but there are people who can help you with this. So one of the biggest problems is that people will tend to want to spend their money and get instant gratification on something that they purchase, but they're not investing for retirement or the long haul. And those same dollars could and should be addressed those ways instead of buying the latest sneakers or whatever it is, or and possibly even the cryptocurrency of the day. It all depends if that's part of your long-term goals, is investing in cryptos or not, and how much of your portfolio you would put that way. But the problem, especially with millennials, and I'll say generally people in their 20s and 30s, is, and especially this younger generation, is that they want instant gratification on things. And they're not necessarily thinking about your typical 25 or 30-year-old is not thinking about putting money into their IRA and retirement accounts. And I have 3 kids myself. I have done my best to push them that way. And they actually have all set up IRAs from the jobs they have. And even my son, who just graduated college, already has retirement accounts set up because of me pushing him to do so and telling him that a good chunk of savings he has needs, some of that needs to be allocated towards retirement, and that he will profusely thank me at some later date and time in life if I'm still around for that, which I probably wouldn't be. But by the time he's ready to retire, I may or may not still be on this earth, but that he will be, as well as my girls, will be very pleased that they have spent 30 plus years putting money towards their retirement. So this is one of the biggest problems, especially with young folks, is thinking too near term about the dollars that you have, and you get a bonus check, and you want to go out immediately and spend it all, instead of putting at least half away for the future. And that future doesn't have to be retirement. It could be towards buying a car. It could be towards buying a house, whatever your financial goals are. But those are the things that you need to pay attention to. So that's one of the issues at hand here, and that this new study identified as one of the most prominent. Second is what's called base rate neglect. And it's kind of a term that you don't quite know what it is just from the title, so there are better titles to call this. But basically what it says is that you're ignoring the original assumptions you made when you made an investment, because some new news came out that swayed you more than the long-term plans of that investment. So investors tend to overemphasize, overreact to this new information. Let's say, for an example, about a stock, often selling more than one should because of a bad news headline that is very short-term oriented and will not have a major effect long-term on the stock, but you tend to oversell, missing out on future growth, or piling into something that's based upon good news short-term, but the news on the stock long-term is not particularly good or credible enough that this is an investment for the long haul. So it's ignoring the original assumptions because you have new, usually very easily accessible data that has swayed your mind about how you think something is going to play out in the future. Number three that this new study came out with, and this is certainly one that is talked about frequently, and that is just general overconfidence by investors. Most investors believe that when it comes to investing, they overestimate their own abilities. And that can cost you dramatically over the long haul. And those who overestimate their abilities are often too concentrated in a few stocks. They think they've done all the work, the homework, and that, these are going to be high flyers. And chances are that they're not going to outperform. They might. And if you were lucky enough to have gotten into Apple 20 years ago and Amazon 20 years ago, etc., yes, you did way better than the market. But generally, the average person doesn't come across those names, isn't invested in those names, but does have a tendency of overestimating just how good they think they are at investing. And it costs them real money. And, here's one of the statistics that I used to talk about in behavioral economics class about overconfidence. Definitely pertains to the male species. So here's one of the more interesting facts I came across and would talk about in class. The average male automobile driver in the United States believes, well, here, let me rephrase it, 77% of men think they are above average drivers. 77% think they are above average. Do the math. That's impossible. Only half can be above average and half can be below, but 77% of men think they are better than average. That is a classic case of overconfidence. And it's overconfidence in our abilities behind the wheel, that we're smarter than other drivers, that we're going to react faster, etc. And the reality is only half of us can. It has to be that way. There's no other way about it. So overconfidence is rampant in our lives, not just in financial decision making, but in most aspects of our lives. And it's often a costly mistake. The last one that they focused on is loss aversion. And this is also very common behavioral finance bias. And it's very simple. We tend to be far more fearful of our financial losses than our financial gains. So it's a disproportionate ratio. The fear of loss is far greater than, let's say, the joy or the accomplishment one has when they have gains. It is highly disproportional, generally in the neighborhoods of 2 to 3 to 1 in favor of loss aversion. And in theory, this should be very well balanced out. If you find yourself being far more fearful of losses than gains, than having gains, then your emotional balance when it comes to investing is off. If you find yourself holding on to losses far longer than you will hold on to gains, you're out of balance. And there's a real problem here, because if you are too fearful to lock in a loss and admit that you're wrong and get out of an investment that clearly is not working, and take those proceeds into putting them into something that could be far more beneficial to you, all because you're fearful of losing money and locking in the loss and having to admit that you messed up and you got into the wrong thing or at the wrong time. This is going to cost you over time, and you are going to hold on to substantial losing stocks and investments that will disproportionately have a very material effect on your long-term investment results. So these are 4 things. I'm going to just go back again before we review some of the things you can do. But again, present bias or current bias, just putting too much immediate attention on what's going on now, and having instant gratification versus putting money for longer term important financial goals. Ignoring your original assumptions, the base rate neglect bias, ignoring original assumptions because some new piece of information has come out that has made you totally throw out what was the longer term assumptions based for some short-term headline. Overconfidence, just believing far too much in your own abilities. And you know, when we talk about this too, this is, you know, stock picking versus just investing in, you know, spiders, Qs, and IWM and things like that, just ETFs that track indices, broad-based indices. And sometimes people put way too much into a small amount of stocks thinking they can do better than the market over time. And of course, loss aversion, having a disproportionate negative feeling about losses than you would about having positive feelings about gains. So what are a couple of things you can do? There's far more than this, but what are a couple of things you can do? Be mindful in the first place that these 4 and other behavioral finance biases exist. There are tons of books about them. Months ago, I gave you a list of, I think, my 10 or dozen favorite books on financial biases and just in general behavioral finance theory. Track those down. You can do a Google search on, you know, great books on in this subject. It will help you much over time. Number 2 is slow down important financial decision making so you don't make impulsive type financial moves. You know that old saying about sleep on it? Well, yeah, sleep on it. Even sleep on it a few days. Don't jump into big cost spends. Don't go plunk $50,000 into Bitcoin because some friend tells you about it. Think it over. And probably most importantly, determine what's really important to you and your long-term financial goals. And then be disciplined enough to stick to them. And if you can't, get some help from your spouse, from another person that you trust, from a financial advisor, whoever it may be, so that you can get the aid you need and the support you need not to make impulsive decisions and to stick to your long-term financial goals. So that's this week's financial education portion. Let's switch to some charts. So let's start off with just the macro stuff, the Qs. All right, so we are very close to all-time highs. All-time highs were made late April. We're getting very close to breaking out above that the low 340s. Today, you can see we're near the lows of the days. We have been in a trading range as of recent with 9 highs, 9 low, 9 highs. So setups have been good in the sideways range. Today, if we close down, and then tomorrow we close above 336.67, and Thursday gap higher and close higher and close above tomorrow's high. you have a real breakout with the next target at 357, and then other targets at 375 and all the way up to 396. So it hasn't done it yet, but the cues are on the verge of breaking out. Let's take a look at the US 10-year. Short term now on the daily chart. This purple line is the 100-day, the 100-day moving average. This dark blue line down here is the 200-day moving average, which right now is at long-term, more important support down near 1.15%. But look, rates are in the one right now at 1.53. Low in early May was intraday 14.71 in the TNX, which equates to 1.47%. You can see that we bounced off of the bottom of the cloud. So this is kind of, once again, an interesting type position towards the lower end of the range. It's the third time down here. So right, middle of April, early May, early June. We did peak on the 13 one day before the high. And we've been going sideways since. So that's been a very effective signal. If we break the 100-day, you have potential support down at 1471. And then when the lagging line hits the bottom of its cloud, which is probably going to be near 1.38% or so. On the upside, still have resistance up to about 170 and 175 and about 187. And lastly, let's take a look at growth versus value before we start getting into some individual REIT names. So here's just a basic chart going back to a little over a year. And the important thing here is that when the chart goes up, it means growth is outperforming value, right? So here's the big top. Chart going down means value is outperforming. So we broke through this key support level on the top. This is even somewhat of a modified head and shoulders type top. We break down, got close to what the target would be of just over 2 bars worth, which is 0.4. So we got from 0.48 to just about 0.44. So we got very close to the target. And then recently, in the last few months, the same lows have been holding. So we could easily get back to towards here where there should be some pretty stiff resistance, which we had it the first time. And we'd see if it, second time probably should hold around there too. But that's the look right now. And let me pull up just a 200-day. Okay, so we're beneath the 200-day. But if you look at the 200-week, you'll see we're way, way above still. So you're in between finding resistance. This is going to roll down. So you should find some resistance probably at the 200-day, which could easily end up being the same thing if this rallies towards where we'd expect resistance. And that's that. All right. And now we have, I don't know, 5 or 6 minutes left. We'll try to get through as many of these REIT names. Again, REITs are breaking out. So I'm going to start with, we'll get to as many of these as we can. American Tower, the biggest weighted name in the XLRE, awfully close to all-time highs. If you can get through 272 and change, then next target is up at 295. Look for support now at 250. PLD, Prologis, on all-time highs, getting closer. We're an 11 towards the 13 on an aggressive combo. Sequential is only on a 4, so this could have room to go. We're through virtually every target except for one that still exists at 125. That's only $2 away. This has room to go on the downside. Look for support at 114. Crown Castle, CCI, all-time highs. If you can get through 189, look for targets here north of 210. Support now at 185 and change. Equinix, EQIX. Same thing, very close to all-time highs, some resistance, 838 to 856. If we can get through here, this has massive room up, measures all the way up to 1,091. Support now at 7, where do we have this? Let me see, 747 and change. PSA, public storage, all-time highs. It's gone through all known targets. Support 266-ish on pullbacks. I don't even see, other than just about where we are, 289. Yeah, we're through it, 293. Don't have any upside targets that I see right now. I could build one, but don't see it right now. DLR, close to all-time highs. Most of these are all, looking very similar. Propulsion exhaustion target 159. We're there right now. If we get through that, look for 168 to 171, and then up in the low 190s. So room there. Simon Property Group, not on all-time highs. Let's take a look here. Not even near all-time highs, and right against the 200-week moving average. So I would say right now, being that we are in a setup 9, we're just beneath the, hold on, let me go into this line. We're just beneath the TDST line at 149. The stock's trading 134. Okay, so it still has 10% upside. But this is certainly the weakest name we've looked at and the least desirable one to be in at this point. So the other ones probably are a heck of a lot better and closer to real breakouts than this is. Support not till 98. That's 40% down or so. Not relevant to how this is trading. SBAC, close to all-time highs. Let's see what we got here. So those were made back here last year, 306-ish. Oh, what am I misreading? Sorry, high 328 and change. We're at 315. If we can get through this 316 level, then we have higher targets that go as high as 350. Support now at 295-ish. Wealth Tower, 9 and 13. That's been stalling us for the last couple of weeks. Got a couple of Friday closes above 77.60. Next target would be 86-ish to 80. Let's see, 87.5-ish. Support not all the way lower right now at 61. That'll move higher if the stock moves higher, but right now that's where support is. And the last one, CBRE, on multiple 13s here now, so would not be chasing. Last time we had multiple 13s, it was the top. Hard to see why this would be a top right now, just given how the sector is moving higher. But it says supports at 81.30. Rather be a buyer there than what we're facing right here with the multiple 13s at hand. So that is our show for the week. I hope you enjoyed it. I am Rick Bensignor, and this has been In the Know Trader.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every